Hey everyone, Jeff Dorman, Chief Investment Officer at Arca, back again for another edition of That's Our Two Satoshis Live, where we talk about what's happening in the crypto markets, which this week is quite a bit. Um, you know, Most likely, if you're a casual crypto trader, you probably have no idea what even happened last week. If you logged off on Friday afternoon and came back on Monday, hope you had a nice weekend. Prices were down a little bit, no big deal, kind of in line with the same, declines that crypto sees periodically. Especially knowing that the equity market fell 3% on Friday, and you have more tariff headlines. Much ado about nothing if you're a casual trader. If you are fully in the trenches, however, you had a rough weekend. It was one of the biggest futures liquidations we've ever seen. The headline number is 20 billion. It was probably way bigger than that, probably in the 50 to 100 billion dollar range in terms of liquidations, because Binance and others on the centralized exchange front don't really report their numbers accurately. But this was certainly one of the biggest futures liquidations we ever saw. Some incredibly painful wicks down to incredibly low levels. That was much more technical and mechanical in nature. Than it really was fundamental. Again, you had a weak equity tape on Friday, you had tariff headlines, and then all of this happened Friday night and into Saturday morning, which is not the most liquid time in the market. So a lot of people freaking out. Obviously, first of all, I'm sure there's some people who had pretty rough P&L experiences, maybe even were wiped out completely using leverage. So I don't want to make light of that. But I think, honestly, in terms of just the takeaways from the market, there's a couple that are important. And again, I think that this probably blows over and it just becomes a blip on the radar at some point. I mean, there was nothing really inherently interesting about this crash, other than the fact that a few things broke. So let's go through it. Again, just for some numbers, Bitcoin, I think, wicked down all the way down to 102, although most of the trading happened around 110 to 114. ETH was down in the, I think, high twos or low 3,000s. Solana maybe in the 130s, things like XRP in the 150s. These were like milliseconds that it traded down there. It did not last very long because these were not real prices. So let's think about some of the takeaways here. Number one, as I mentioned, this was very technical and mechanical. This was not a fundamental crash. And what I mean by that is fundamental crashes like the FTX bankruptcy or Terra Luna unwind or the 2008 mortgage crisis or the dot-com bubble popping, all that, those tend to be associated with a real decline in earnings or cash flows, leading to defaults and bankruptcy. Sometimes there's even fraud involved. That's not what this was, right? A technical or mechanical failure, things like the repo hiccup in 2018, or the yen carry trade imploding last year, or flash crashes like in 2015, or May 2021 in crypto. These tend to be completely short-lived. There's no real follow-through, and there's really nothing to blame other than the fact that sometimes, if you don't have real regulation in place with circuit breakers, or you have too much leverage, sometimes prices go to levels that don't make a lot of sense, and it's temporary, and it doesn't really matter in the big scheme of things. But what does matter here is that there really was nobody at fault here. This wasn't like the exchange's fault. It certainly wasn't the market maker's fault. There wasn't any Washington insider circles or anything. This is just what happens when you put way too much leverage on, crappy assets, and you use other crappy assets as your collateral, right? I mean, let's face it. If you're using something like USDE, which is the algorithmic stablecoin of Athena, you can be as excited as you want about Athena and all the looping and all the fun things they do to make it pretend that it's a stablecoin, but it's not a stablecoin. Nobody uses it for anything. It's not backed by government bonds like Tether and Circle are. If you're using that as a collateral for leverage, yeah, there's a good chance that the dollar price of that stablecoin is going to temporarily fall once in a while just because of market forces. It doesn't mean the peg broke, right? The mechanism for redemptions and withdrawals on Athena's stablecoin didn't break, but the price went down to 60 cents in the dollar. And if that's what you're using for collateral, you're going to have a margin call and you're going to get liquidated if you're using futures. Similarly, if you're, putting massive leverage on things that are 70 or 80 vol assets like crypto, there's a good chance you're going to get liquidated, right? Like, that's just what happens when you put leverage on assets that shouldn't be levered. So this is not new. It's normal. It's going to happen a lot. It's painful when you get caught up in it, but it's for those who want the upside of 10x and 50x levered positions, it comes with downside as well. The other thing I'd point out, and I put this in the blog as well for those who want to read it, like, I've been saying for 7 years now that crypto trades more like high yield bonds than it does like equities and commodities, right? People want to pretend it's the equity market because you have these live prices every day that people trade, but it's just not. The way the bond market works, the corporate bond market, is you have fragmented liquidity. You have all these different dealers making markets. There's no centralized exchange. There's no centralized place where all the trades happen. And as a result, when you have fragmented liquidity, all it takes is one price break for everything to break, right? So imagine, you have 10 dealers, your JP Morgan, Goldman, B of A, Barclays, et cetera, and they're all making a market on a bond called 87, 88. And then all of a sudden, one guy starts getting hit a ton of times by one big hedge fund, and he takes his market down from 87, 88 to 84, 6 to 80, 82, and eventually it's down to 50, 55. Like, it doesn't matter if the other 9 guys were making markets higher. If one guy is getting dominated by all the supply, the price is going to go down and it's going to make things break. So if you had a ton of leverage on the high yield bond market when something like that happened, you would get liquidated. But that doesn't happen in high yield bonds because, again, normal people don't put that much leverage on assets that can fall 30 or 40% in a millisecond. So if you actually study the way corporate bonds trade, it's much more similar to how crypto trades, with this fragmented liquidity and a lot of liquidity that looks real until it doesn't. If you ever got caught up trying to trade corporate bonds during a period of high volatility, dealers go away, their markets shrink, there's nothing really available to trade, everything's quoted at prices that isn't real. That's the same thing that happened in crypto, except that everyone has these expectations that there's trillions of dollars of liquidity when it's just not there on these assets when they go down like this. So again, I think this is not anyone's fault, other than the fact that the exchanges offer this much leverage. I mean, you can even go back to Brian Armstrong at Coinbase when they launched their European perp exchange. They bumped max leverage from 20x to 50x because customers wanted it. So, if you're going to dance in a casino that offers this kind of odds, you're going to get hurt once in a while, right? It's no different than if you walk down the Las Vegas Strip and you play a craps that most of them have 3 or 4 or 5x odds, and then you walk into the Imperial Palace with 8-foot ceilings and a cloud of smoke in your face offering 100x odds. You get a different experience when you increase the odds and you increase the leverage. So if this is what crypto people want, which I think the market has spoken that for the most part that is what they want, it comes with this kind of downside too. If a handful of people who are largely addicted to trading in the space get liquidated, it's probably not the worst thing in the world for the overall industry anyway. The last thing I would say on this, or maybe the last thing, a couple more things here, is that a lot of people are saying that this wasn't fair for low risk trading strategies like market neutral funds. Market neutral funds, of course, being where somebody is long and short 2 different assets, so therefore their overall risk is not that high. And that's also just a fallacy. That's not true, right? Just because you're long and short, that means you have less price volatility and less directional price risk, but it doesn't mean you have less risk. You still have counterparty risk. You still have leverage risk. You still have exchange risk. Like, these are real risks that people who run these strategies should have been aware of. And if they weren't and they got taken out in this, again, you're marketing something as much lower risk than it really is. And these are not, unexpected scenarios when you're running a strategy like that. Similarly, I've heard a lot of people saying that retail got liquidated here. Like, that's also not true. Your average retail trader, like I said, probably logged off on Friday night and came back in on Monday morning and didn't even know this happened. It was the crypto degens and professional crypto traders that really got hurt by this. These are guys who made all of their money on airdrops and farming and using crypto, and were well aware of the risks of these perpetual futures exchanges. Again, if you just held spot and you saw Bitcoin go from 120 to 102 and back to 114, you're like, okay, whatever. It's down 3 or 4%. It happens. But if you own futures, you probably got liquidated in position. So most people don't use futures. This is not a retail product. This is a professional cohort of crypto people who got rich using these strategies. But again, they knew the risk when they were doing it. So I don't think this has any sort of a systemic effect on the market. Lastly, I think, and this is probably the most important point here, is that, the actual protocols themselves, as they always do in these things, worked really well. Like, there was no downtime on the layer 1 protocols. Things like Aave and Uniswap function terrifically. Hyperliquid, no downtime at all. The actual protocols and systems that allow for trading of these assets had 100% uptime with no problems. This is not a problem of crypto and blockchain in the industry. This is a problem of the assets that trade today on crypto rails. mostly suck. There's a few really good ones. Like you've heard us talk about things like Pump.Fun, which is a real business that dictates their cash flows to the token, or Hyperliquid, same thing, a real business that made $40 million in fees over the weekend and dedicates all that money back to token holders. There are a few good tokens here and there, but the majority of these assets, like meme coins and layer one tokens and some of these algorithmic stable coins, they're just bad assets. They're bad assets built on really cool blockchain rails. One day, if you believe that what I believe, which is that a blockchain's sole purpose is to move assets, well, one day you're going to have better assets available to move on these blockchain rails, meaning 99% of the world's assets are stocks, bonds, and real estate and gold. So when you start to have better assets on blockchain rails, you're not going to have these problems. This was not a failure of crypto or blockchain. This is a failure of a bunch of terrible assets that people trade with high leverage that there's no real demand for when things get dicey. So again, not a problem of the industry. It's a symptom of people chasing bad tokens that they probably shouldn't be investing or trading in the first place, let alone with massive leverage that comes with liquidations. So where does this leave us going forward? Look, I think, as I said, this is much ado about nothing. It's going to be a blip on the radar. It's going to be a footnote in some book on crypto one day. It doesn't matter, right? Prices are bouncing back for good reason. At least of the decent assets. We know that the U.S.-China tariff thing will eventually come to an end and probably won't escalate too high. Again, most flash crashes, which is what this is, usually have V-shaped recoveries because it wipes out a lot of leverage and excess in the system, and ultimately you move higher from there. So we'll see if that's true or not this time. But again, read the entire blog if you want to see some of the detailed charts and some of the stuff we put in here talking about why this likely ends up being much ado about nothing. That's it for this week. Check out the blog. That's our two Satoshis at ar.ca/blog. Hit me on Twitter, jdorman81 if you want, and we'll be back next week. Thanks, everybody.